Hey everybody, welcome back to Dividend Stockpile. In today's video, we're going to be breaking down 4 infrastructure-related investments: UTF, ASGI, IGF, and BIPC. The idea for this video came from a viewer that wanted to get more information on ASGI, so instead of giving information on that one investment, I decided to go ahead and compare 4 in the infrastructure space so you can determine which one deserves a spot in your dividend portfolio. So whether you're looking to invest in real assets, hedge against inflation, or just add reliable income, infrastructure is a dependable and essential sector to consider. So let's get into it. All right, so before we go through these 4 investments, let's talk about why infrastructure is such a big need. So according to the McKinsey Global Institute, the world needs to spend about $3.3 trillion per year just on core economic infrastructure. And we're talking about transportation, power, water, etc. They also estimate that the total infrastructure investment is going to be about 3.8% of global GDP each year. In addition to that, if you add on the UN Sustainable Development Goals, we're going to need an additional $200 to $236 billion per year, pushing the total up to $3.5 trillion per year through 2030. So based on that estimate, the world is short about $350 billion annually in basic infrastructure spending. Even if we get to the $3.3 trillion a year spending that's recommended from the McKinsey Institute, we're still going to be short around $350 billion annually on just basic infrastructure spending. Most governments around the world don't have that type of money to invest in the infrastructure, so private industry is going to have to take up the slack and use money to build that infrastructure. And that's where these 4 investments really come in. So infrastructure investing has grown in popularity because of its stability and the income generating potential. And so infrastructure, we're really talking about the backbone of modern life: utilities, toll roads, pipelines, telecom towers, railroads, and even data centers. So generally, why is it good for dividend investors to invest in infrastructure? Well, they generally provide steady cash flows, they're monopoly-like business models, and a lot of their contracts are inflation linked. So the amount of revenue is going to grow over time with inflation. And it often comes with government or other long-term contracts to provide stability in their revenue. And of course, based on that revenue, they're going to have strong dividend potential. So our picks today, again, are UTF, ASGI, IGF, and BIPC, all approach infrastructure investing in different ways. So let's start off with UTF. So UTF is the Cohen and Steers Infrastructure Fund, and it's one of the most popular closed-end funds in this space. Their strategy is that they invest in listed infrastructure companies around the globe, like utilities, toll roads, pipelines, communication towers. It also uses leverage to enhance income and the total return potential, and it's actively managed by Cohen and Steers, one of the top-tier real asset firms. So the investments that UTF makes are pretty global, with only 57% in the United States, 10.73% in Canada, 4.9% in the United Kingdom, and 3.92% from Australia, and smaller percentages from a lot of other countries. UTF has a total expense ratio of 2.77%, which is high, but it does include management fees and leverage costs. For everyone's awareness, if a fund like this one borrows money to make investments, they pass on the interest rates to the investors. So when you add up the leverage and the management fees, it is quite high, but that's typical anytime a fund uses leverage. The current leverage they use is around 28% of their net asset values. As of the most recent reporting, their top holdings include NiSource, NextEra Energy, Duke Energy, TC Energy, and American Tower. But they do hold around 259 holdings. For the distribution rate, as of this recording, UTF pays a monthly distribution with a current yield around 7.13% based on the market price. And they have paid monthly dividends consistently since their inception in 2004. And they do have a managed distribution of 16 cents per month per share. Performance. So this is where it really shines. The performance as of June 11th for 1 year is about 22%, 5 years, 11.5%, and 10 years is about 10.4% a year. The fund is currently trading at around a 3.8% premium to its NAV, which is on the higher side for them. But their long-term performance and steady income stream have made it a favorite among income investors, despite the high fees. The use of leverage helps in good economic times, but could be a drag in downturns in the future. Next up, we have ASGI, the Aberdeen Global Infrastructure Income Fund, another closed-end fund with a more conservative approach and a global reach. So ASGI invests in high-quality infrastructure assets globally, but without leverage. It also includes private infrastructure investments, offering exposure to hard-to-access deals. Their expense ratio is still high, but it is lower than UTF, and it comes in around 2%. They do not use leverage, which reduces risk in volatile markets. As of the latest reporting at the end of May 2025, they have 65 holdings, and their top holdings include Trinity Gas Holdings, AENA SME, Ferrovial SE, NextEra Energy, and Infinity Global. It's slightly more international flavor than ETF and has a mix of developed and emerging markets. Only about 32% is in the United States. France has a little under 10%, Spain 6%, the UK at 5%, and Canada just over 4%. ASGI launched in 2020, so its track record is shorter than ETF. It does pay a monthly distribution, and the current yield is around 12%. The payouts have been varied, and it's not as stable as ETFs. The performance as of June 11th for 1 year is around 9% increase. For the almost 5 years they've been around, it's 9.8% a year. And it currently does trade at a discount of negative 5.84% to its net asset value. So if you're looking for infrastructure exposure without leverage risk and some private equity flavor, along with a higher distribution, ASGI is a solid, steady option. Next up is IGF, the iShares Global Infrastructure ETF. This ETF is run by BlackRock under the iShares name, and it provides a passive approach to infrastructure. The fund invests in stocks from the S&P Global Infrastructure Index and has holdings in most infrastructure sectors like energy, oil, industrials, transportation, airports, highways, utilities, and ports. Because this is a passive index approach, the expense ratio is much more reasonable at 0.42%. As of June 10th, their top holdings is ANEA, SME, Transurban Group, NextEra Energy, Grupo Aeroportuario del Pacifico, and Enbridge. And they have about 95 holdings in total. Their geographies are also very varied, with the United States coming in about 38% of the assets, Australia at 9.4%, Spain at 8.73%, Mexico at 8.16%, and Canada at 7.25%. IGF launched in December 2007, so its track record is pretty long. IGF pays a semi-annual distribution and a current yield of about 2.85%. The payouts have been varied throughout that time, so they're not as stable as the managed distribution of ETF. Now, the performance has been very strong. Over the last year, it's up 26.7%, and their 5-year average is 11.89%, with a 10-year a little bit lower at 6.57%. So if you're looking for infrastructure exposure without high fees, IGF looks to be a solid long-term winner. And last up, we have BIPC, which is the Brookfield Infrastructure Corporation, a direct play on Brookfield's global infrastructure assets, but is structured as a C Corp for U.S. investors who want to avoid the K-1s. So Brookfield Asset Management, which is the owner of BIPC, is one of the largest alternative asset managers in the world and is based in Canada but operates throughout the world. BIPC is a subsidiary of BAM and owns and operates a diverse portfolio of real infrastructure assets across 4 sectors: utilities, transport, midstream pipelines, and data infrastructure. So this includes toll roads in South America, ports in Australia, telecom towers in India, and pipelines in North America. As a stock, BIPC doesn't have an expense ratio like an ETF or C closed-end fund has, but Brookfield does charge management and incentive fees within its corporate structure. These aren't transparent like the funds, but they are baked into the operating structure of BIPC as a subsidiary of Brookfield. BIPC is essentially one holding itself. So you're buying a share of Brookfield's infrastructure assets, so you get exposure to dozens of companies and projects worldwide. BIPC pays a quarterly dividend, and the current yield is around 4.18%. The dividend has been growing 5 to 9% annually and is supported by long-term contracted cash flows and a backlog of Brookfield's future deals. So BIPC was launched in 2020 as a mirror to Brookfield Infrastructure Partners, which is BIP, which is a limited partnership. So it has a short history of dividends, but has increased its payout annually, in line with BIP's long-term track record of between 5 and 9% a year. Total performance for the 1 year is excellent at 29.66%, 5 years almost at 9.58%, and of course the 10-year we don't have yet because it was only started about 5 years ago. But BIPC offers an excellent mix of capital growth and income potential, especially for long-term investors who want qualified dividends instead of an MLP tax complexity and the annual fee that the other funds charge. So here's a side-by-side comparison of UTF, ASGI, IGF, and BIPC to wrap it all up. As you can see, UTF and ASGI are closed-end funds. The yield is 7.3% and 12% respectively. The expense ratios are 2.77% and 2%. They both pay monthly, and their 5-year returns are 11.5% and 9.8% respectively. They both invest in global listed infrastructure, but ASGI offers private infrastructure investments as well. IGF is our sole ETF, and it does not have any leverage, and the yield is a lot lower at 2.85%, and the dividend is paid semi-annually, so you want to get 2 payments a year, but the total return has been excellent at 11.89% for the last 5 years. And it does invest in globally listed companies, but in a passive index approach. And last up, we have BIPC, which is our individual stock. It does not use leverage, and the yield is 4.8%. Because it's an individual stock, it does not have an expense ratio, and they do pay their dividend quarterly, and the 5-year return has been 9.58%. And with BIPC, you get a direct infrastructure ownership and the backing of Brookfield. So I would say UTF is the best for high monthly income and long-term total return, if you're comfortable with the leverage and the high fees. ASGI is great for those who want a high yield, global exposure with less volatility, and some access to private deals. IGF is geared to those who like a passive approach and aren't looking for the highest yield, but want long-term capital appreciation plus a little bit of income. And lastly, BIPC is ideal for long-term investors seeking a growing dividend backed by world-class infrastructure projects. So for the bottom line, globally, we need to spend roughly $3.3 trillion per year on core infrastructure and an extra $200 to $300 billion a year for the Sustainable Development Goals compliance. So if we include the scale-up for green and energy systems, the expenditures rise to $3.5 to $4 trillion per year. Again, local governments were not going to have the money or the capacity to do this all themselves. So most of that money will go to public companies like the ones we talked today. So which infrastructure plays best for your dividend strategy? So let me know in the comments which of these, UTF, ASGI, IGF, and BIPC, do you prefer? Or if you hold all 4, like a true infrastructure investor. I personally have BIPC, and I've held UTF and IGF in the past. So if you got value out of this breakdown, please don't forget to hit the like button, subscribe for more income-focused investing, and ring the bell so you never miss an episode. Thanks for watching, and remember, keep stockpiling those dividends.